conversation will be Jason Hollander and Steve Conwell. Jason Hollander is the managing director of IAG M&A Advisors, an advisory firm established in 2009 with its headquarters in Addison, Texas. IAG's assisted hundreds of sellers throughout the exit process for a total enterprise value of over $3 billion. And they have a combined management experience of over 100 years. IAG is a client-focused, process-centered organization that will lead the industry by helping our clients succeed in a rapidly evolving world. Steve Conwell is the CEO of Final Ascent, which was founded in 2017 in order to inspire the middle market to create built-to-sell businesses. He is also a board member of Value Builder and seeks to help businesses achieve maximum efficiency with his plans. The collaboration began because both IAG and Final Ascent have comprehensive and complementary plans for business owners who want to sell their business for maximum value. Therefore, we hope this webinar will help educate sellers on how to start that process.
Thank you, Tatiana. And Steve, thank you for the time today. This has been a great collaboration between our two firms to really offer the most comprehensive exit plan that we know of to the market. So Steve, if you'd like to go ahead and get into this information for everybody. So we're probably not going to go over an hour, and that's our goal. So we'll get into it. Thank you.
Yeah, thanks a lot, Jason and Tatiana. Yeah, I'll tell you, building business value for your companies is a slippery slope. I mean, all the stuff that you've been taught on building your company and the entrepreneurial genes that you have to get you from A to B may not necessarily get you there when you decide to sell your company. And this is why we're having this conversation. One of the things, you talk about like an owner's trap. When you began your business, the challenge oftentimes is that you're the expert, right? And so you're going to initially do the selling for your business. You're going to potentially offer too many things because your customers, as you start to grow, ask for more products and services. You're oftentimes the only one who's capable of delivering, especially as things get more complex. And then you interface with the customer. And so it becomes a challenge for the business, because what happens is the business slows when you're away, right? You have customers that go to you when there's a challenge versus, let's say, your salespeople or your client service and delivery team. And oftentimes the revenue starts to plateau because you have only so many hours out of the day. And you start to lose your freedom in the business. You end up working 60 hours a week, you're wearing too many hats, and in effect, you end up actually affecting the value of your company over time. And so this becomes a big challenge. And ultimately, what we want to do is give you some tools and information to help you not only free up your time, but free up the business from you. And what does that do? That allows you to scale your company and take it to the next level. Allow you to realize your growth potential for the business because you have other people who are executing your vision, but it's also going to allow you ultimately to sell the business for maximum value, or potentially pass it down to your employees or maybe your children on the next step. Ultimately, because it's free from you, you could end up just being a chairman of your business versus one of the team members trying to execute. And so ultimately, we're talking about freedom here. And we're talking about building a very valuable company that is free from you, right? So that when you take a vacation for 3 months, the business continues to grow and expand. So the system that we use, one of the tools that we use is called the Value Builder system. Approximately 60,000 people have taken the assessment that we'll talk about later. You'll get what's called a sellability score, and it's all based on 8 key drivers of value. Now, what's interesting is that businesses on a scale of 0 to 100 that score in the 80 plus category will sell for 71% more than the average business, who really only scores about a 57 across the board in all industries. So this is very important. The one thing I want you business owners to do when we're having this conversation is put your buyer's lens on. So I want you to look at what we're talking about in terms of how a buyer sees your company, okay? When you do that, you're going to be able to look at it objectively and understand that buyers are hunting for companies that are strong and these key drivers of business value. Okay, so let's begin the journey. The first driver is financial performance. And we're talking about the history of professional record keeping that you have in combination with the history of producing profits and revenues. So think about like thriving, not surviving. And we're going to talk about a financial buyer and how they look at your company, because they look at it differently from you. They're looking at projected future cash flows and what are they worth now. So what does that mean to you? So here's a simple example. They're going to say, how much profit will your company generate in the future? And then how reliable are those estimates? Because if they're not reliable, they're going to be somewhat concerned about that. They're all about mitigating risk because they don't know all about your company, and they may be evaluating a couple hundred companies to determine which one they would like to buy. So let's do an example here. The present value today of, at the end of the year, your pre-tax profits of $1 million. Let's say that you, at the end of the year, 12 months worth of work, had $1 million of net profits on the bottom line. What would that be worth today if you were to discount it back 12 months in the future back today? Well, they would use 15% to discount that to $869,570. It's basically $1 million divided by 1.15%. So if they were going to buy your business with these pre-tax profits, they'd write you a check for 869 grand. What they're going to do is they're going to project in the future. They're comfortable with your estimates. And so they're going to look at the second year and say, okay, you got $1 million of pre-tax profits. It's worth 756,000 and change. Basically, they're taking 1 million divided by 1.15 divided by 1.15 again to come up with that. So what is that? Roughly 1.6 million they would pay for your business. And then they go through 10 years in the future. So they would say, if I'm going to write you a check for your business today, assuming that you just made $1 million in pre-tax profits for 10 years, I'd write you a check. They'd say that that is worth $5 million and change, right? Now, here's the thing. Let's say that they're not as comfortable with your estimates. You do the cash basis accounting versus accrual. Stuff isn't as accurate and complete. There's some issues with your record keeping, maybe issues with your projections, and they're not as comfortable. And so you have business too that's also showing 10 years of $1 million of net profits. What does the financial buyer do? They discount that and they say, we're going to do a 50% discount because this is a more risky business. And so end of year one, they're going to take $1 million and divide it by 1.5. And that's why this then is only 66,000. And you can see because this is more risky in their mind, look at how rapidly the present value of these future pre-tax profits are for this business. It's a lot less, right? So you've got two businesses in 10 years generating the same pre-tax profits, but the offer to that business owner is significantly different. I mean, you're talking about, oh my gosh, I mean, the one business is worth a little less than 2 million, the other is worth 5, same pre-tax profits. And so this is how financial buyers are going to make an offer for your business based on risk. And typically they'll go anywhere from between 15 and 50%. What you can do is you can do an exercise. And at the end of this, we're not going to go through the appendix. We've got exercises that you guys can do. You can determine what you think your pre-tax profits are over, let's say, a 10-year or 5-year run. And then what would that discount be? I'd recommend probably 25%, and then go see what your business is worth. So very important exercise to go through in thinking about the psychology of a buyer. I will recommend for you guys two things. One, make sure your financials, if they're on the cash basis, convert them to the accrual basis with your CPA, and make sure they're accurate and complete, and use an accounting package like QuickBooks Online so that you can produce consistent financial statements. Now, the next key driver is growth potential. So think about your ability to scale and grow your business. So buyers are hunting for companies that they believe they can really scale and grow, right? They're wanting to buy a company that based on their analysis, they can really take to the next level because they're going to have big sales teams, more than likely big marketing budgets, and they can blow up your company. So they're hunting for companies that have this potential. One of the biggest things that we like to tell people is sell fewer things to lots of customers. And one of the things that's important is when you sell fewer things, you want them to be teachable, valuable, and repeatable. So teachable to your employees who are going to execute, whether it's designing it or delivering it, valuable to your customers, and repeatable, meaning that you can sell lots of it over and over to your customers. And so let's look at a business that does photography. When they analyzed the different services that they provided on a scale of 1 to 9, what was for each service, how teachable, valuable, and repeatable was it? So weddings, you would hope that they're not repeatable, but look, at the end of the day, you may get 3 weddings out of somebody if they have a bunch of divorces. It's definitely valuable, but not as teachable because it's customized. If you did photography for, let's say, baseball teams or soccer teams as an example, really easy to teach an employee how to do that, not really valuable, and yeah, it could be repeatable. Corporate events, which could be, the Christmas party, etc. Hard to teach that because there's a lot of custom and pictures and things that you have to do. Definitely valuable, but not as repeatable. But where this company hit the home run was on school photos, because starting from even pre-K, kindergarten, all the way through to high school, 2 times a year, you could have school photos done. Really easy to teach. A valuable thing because parents want to show that record of their kids over time. And plus you got to get the goofy picture of the kid wearing his PJs to school, right? And then it's repeatable. And so you have a customer potentially 26 times over the course of the years they go through the schools. And so that becomes really valuable right there. And that was the only service that they taught. And they could hire people to do this. It's valuable to the customer and very repeatable. And so it's rinse, repeat. When you look at it, corporate events are very valuable, but they're not as teachable. Doing the team approach, you could definitely teach people, maybe different things that need to be done, but it's really not as valuable, right? But school photos right here really fits the bill. Now you could argue, hey, weddings are obviously more valuable from those pictures, but they're not repeatable. And that's one of the challenges there. And look, from a customization standpoint, each wedding's different. Each type of venues are different. And so the teachability side is much harder. So that's a really good example of this is where the growth potential is for this business. The challenge oftentimes is you see when you go through an exercise list that things that are very valuable are less teachable, and things that are very teachable are not as valuable. And so we're going to show you an example here of a business that provided accounting type services to companies. Obviously, we all have our own companies and we do accounting, we do different consulting work out there. We provide and work with strategic partners as an example. And if you look at this accounting type work and doing audits and corporate finance and the stuff down here, really teachable, mostly repeatable, but not really valuable in and amongst themselves. However, this business owner created the back office support system and packaged all of these activities together. So what happened is that collectively very teachable, but very valuable to business owners and repeatable because this is a monthly retainer for these fees. So this is an example of now we took stuff that really wasn't valuable, packaged it all together into a service offering and bundle that was valuable and unique to the customers. Still teachable, and the big key here was it's repeatable. So from a growth potential perspective, the advice to reiterate is sell less things, less products and services to a lot more customers and evaluate it from how repeatable, teachable, and valuable it is. Matter of fact, Jason, when you've seen companies that you sell, this whole valuable and teachable thing and kind of that unique selling proposition out in the marketplace that shows their growth potential, how has that resonated with businesses that you've sold, and really the offers that they get?
Well, it makes a difference, because it all goes back to risk. If it's not repeatable and easy to learn, then it's hard to transfer that knowledge from the owner to the buyer. So that creates some uncertainty, which then can lower that value or lower the offer the buyer's going to make. So it does make a difference. Anytime you can start documenting your processes, so when you do want to sell your business through the due diligence process, it will add value to your deal.
No, absolutely. Absolutely. We've seen that time and again where the scalability of the business is not there because you do so many things.
Mm-hmm.
And usually when you do a lot of stuff, it requires specialists to do the work, who are more costly, right? Versus hiring generalists or people with less experience, because it's very teachable and repeatable. And then when it has that value, it's just rinse, repeat. You can sell tons of it in the marketplace. Absolutely. Absolutely. The next driver is what's called the Switzerland structure. So if you remember back in World War II and World War I for that matter, Switzerland was independent. And so this driver is very simple. It's talking about how dependent are you on suppliers, customers, and employees. And this is vitally important because when you look at the market and you look at a business that, let's say, has a product that they sell and they use one vendor for the key end product, and that vendor decides that, hey, we're going to charge more, the quality goes down, we're going to spend more time in getting it to you for whatever reasons because of shipping schedules or how they work with their end suppliers, it creates a risk. But buyers are always trying to figure out where's the risk and do I want to incur that? And so if they feel like you have a supplier concentration risk and that supplier went away and it isn't easy to get another one, they're going to walk away, because what if that happens? It does happen in real life. The same with customers. The recommendation is that if any one customer has more than 15% of your annual revenues, that becomes a risk to a buyer, because what if that customer goes away? I'll give you an example. We were selling a company that had 61% of their revenue coming from one customer, and they used to do flash sales, and they would build flash sales for all these different companies and all the web pages and stuff for it, but then it was on a TV show that it would get marketed out and people would buy it through that flash sale. Well, that revenue from that TV show comprised 60% of the revenue. We had, oh gosh, it was 40 interested buyers. They all walked away because of the customer concentration issue. Ultimately, the business got delisted, but 5 months later, the network canceled the show. And so all the buyers were correct. The other thing is that, do you have one or two, could even be three, very key employees that execute material parts of your business, whether it's the VP of sales, who is your hero on selling, or the person in the back office that is your CFO, that is the wizard getting all of the financial statements done and just helping you grow your business, to somebody, let's say, who's in customer service, who works with all of your customers. List those people out and then determine what strategies can you put into place to keep them, whether it's incentive compensation plans, or somebody may just like training and education, or a bonus that keeps them on track. Each person's different, and so you may have different strategies to keep them on the bus, but always remember that buyers, they're buying your company from you, but they're buying the people as well. And the last thing you want to have happen is to buy the company and then the employees walk away. So all of these, just think in terms of the business not being dependent on these three. Jason, you probably got a ton of examples of this too, because these rear their ugly heads on a sale.
Yeah, absolutely, Steve. They do. So we could, name 100 examples of where this issue came up, and if it isn't addressed or there was too much concentration somewhere, then the buyer would walk away. Yeah.
Absolutely, absolutely. I'll give you a quick example and then we'll move on. Guy was one day away from the sale of his business, and he had a VP of sales, and really it evolved to their chief operating officer for the business. And the owner had just not involved the COO and long-term employee in the sale, so she knew nothing about it. And she was going to sell the company. He was going to sell the company for $10 million. The buyer asked if he could just chat with her. Sits down for her for an hour conversation and says, "Hey, congratulations, we're selling the company tomorrow. I'm going to be working with you and really excited about it." Had a great conversation. She walked out of the meeting, walked into the owner's office, like the seller, and said, "I want $1 million for all the work that I've done." And, had the buyer, now one could argue that she should have gotten $1 million and he should have set up like warrants or something to compensate her. But literally it went from, she'd have probably been happy with, a couple $100,000 and some other things. Instead, he had to write that check for $1 million or the sale wasn't going to happen. So those are just many number of examples of this situation and how it does come up. The other thing, I don't know if you guys remember playing with Teeter Totters, maybe it's a seesaw when you were a kid, and this great, child, jungle gym toy is really talking about cash flow. And so what you want to think about is how much cash do you have coming into the business and how fast does it come in with how quickly does it go out? And so think in terms of if it requires a lot of working capital. So think about the cash that it's required to keep the business operating smoothly. The value of your business goes down and vice versa. So if you think in terms of business owner A has a business valued at $5 million and business owner B also has a business worth $5 million. If owner A, it only costs $1 million to operate the business, and the second business, it costs $4 million to operate the business, there's always two numbers. The buyer's going to write the check for $5 million, but for the first business, he's going to give the owner $4 million, and he's going to keep $1 million in as working capital to operate the business. The other business, owner B, is going to get $1 million because you need $4 million of working capital to continue operating the business. And so this is where cash flow is super important. Can you get customers to pay up front for what you sell? We're all on Amazon as an example, and we all pay things up front. Can you get a customer deposit in? Can you invoice more often? Can you lower your expenses so that the amount of cash that you're burning is less? Can you change the payment terms to due upon receipt, as an example? There's a myriad of different ways to speed up cash coming in. And then with cash coming out, can you ask your suppliers to give you net 45 or net 60 terms? Don't get a bill that comes in and just immediately pay it. If you've got credit for 30 days, wait till 28, 29 days and pay it, and stretch that amount of time that you have cash going out. Remember, cash is king, and through COVID, we saw this, right? Lots of businesses that were managing their cash well were significantly crippled, especially when businesses were shut down, and you could see how significantly it impacted not only their ability to operate, but their ability to go to market as well and to sell. So this is a really, really important one, and it's a shocker because when businesses are sold, they evaluate what the working capital requirements are as part of the sale. I mean, Jason, this comes up all the time where, let's say it takes 9 months to sell the business and their working capital starts shifting over time and it gets more costly to run.
Yeah, that definitely it does come up and is part of the negotiation process to determine what that working capital peg is got to be when it closes.
Yeah, absolutely. So this is a super important one. There are buyers that are hunting for businesses that have high growth potential, that have tremendous positive cash flow engines, and they will write the check and actually compete with each other to give you the best offer, as an example. The other driver of value is recurring revenue. So think in terms of like your cell phone contract, as an example. It's a recurring agreement where you get paid in advance. Sometimes people will pay a year in advance for a service. So you pay software companies, lots of them potentially, a monthly licensing fee to use their software. And you may stick with that company for 5 years or longer. they get that recurring revenue coming in, paid in advance. You may get a discount. Hey, if you pay a year in advance, you get, it only costs you 10 months or 11 months as a discount for doing that. These are valuable companies when they have recurring revenue streams. So let me give you an example here. In the security industry, there's two types of business typically. There is installation, so putting all the cameras and equipment into your house, and then there is monitoring. What's interesting is that in that industry, and there's a lot of other industries that are just like this, for $1 million of revenue, they will pay to buy the company 75 cents on the dollar. So here, $1 million installation business sells for 750,000. However, that monitoring business that protects you in case something bad happens, they're worth $2.50 for every dollar in revenue. So for $1 million monitoring company, it's worth $2 million, which is incredible. I mean, you've got a business here, great business, but only worth 750K because it's one and done. You sell the installation and then you got to go find another customer. With them, they get the monitoring, and look, you may have had a security service that you've worked with in your house for 10 years, or your company selling corporate monitoring as an example for corporate security systems. That difference in valuation is critical, and that's where recurring revenue kicks in. It's just so valuable in the marketplace. Now, we're not saying that your business has to have 100% recurring revenue. There are some that's how it is, and they're very valuable when they sell. But if you can look at what you do and provide like a service agreement, some other product or service that you can sell that people want to buy a lot of, it will increase the value of your company, especially in attracting strategic buyers who see the growth potential, because you may be only selling this, let's say, in your local metro area, and they're looking at a national play, and they can take your business from where you are now and 100x you with their capabilities. So they become very valuable businesses in the marketplace. And Jason, I mean, obviously, I mean, you see this, I mean, time and again, these businesses attract lots of buyers when they've got a lot of recurring revenue streams.
Yeah, it's always a highlight point to talk about contracts or service agreements in the information that buyers look at. So yeah, it is good. It doesn't mean that if you don't have it, it's just some recommendations to think about and work on. Because remember, we're looking at this from the buyer side, you know, how a buyer sees the value in your business.
Yeah, absolutely. And so I just recommend everybody to look at what you offer and see if there are ways to create recurring revenue streams for you. The other thing is monopoly control. So think in terms of how unique is your business such that you can defend yourself from your competition, and how valuable is what you offer to your customers, right? So buyers are always looking for those unique companies out there that are different out there, and they'll pay a premium for them. And what you think about, so that market differentiation, what does that do for you? Well, ultimately, you can control pricing, right? Because you're different. And so you're not selling with the bottom feeders who are trying to sell it at a low price. You can actually command higher prices for what you sell, which ultimately gives you higher gross margins and more cash coming in. And that's a significant thing here. What does it allow you then to do? You have more money for marketing out there, which gives you more ways to market differentiate because you're selling more and more of your product, which allows you to control pricing anymore. So the beauty is that this just becomes a domino effect. And so companies that are very unique in the marketplace, that are different from their competition, but can defend themselves against their competition, and then they create raving fans where customers keep wanting to buy more, they're very valuable in the marketplace. And you always see new ones coming out. When Uber came out, I mean, their market cap 4 or 5 years ago was $50 billion that they were valued at on their market capitalization, because they created something completely new in the environment. And obviously they're global and gigantic. I mean, the Amazons of the world, Instagram, they got bought by Facebook, had only done, oh gosh, I think it was like 6 million in revenue when they got bought, and they were valued at 1.1 billion because of what Facebook could do for them. So all of this stuff on looking at your competition and evaluating out in the marketplace what your competition does, what do you do differently, is going to separate yourself when you go to sell your business from competition that's out there, especially if you have a buyer who's looking at businesses in your industry. What makes you different? And if you've got that uniqueness about you, that kind of blue ocean thing that you've created that separates you in any industry, you're going to be very valuable out there in the marketplace, and you're going to attract a lot of buyers. I'll give you an example with Panasonic. They were wanting to get into the notebook industry. And the problem was that they looked at Apple, I mean, all the sexy MacBooks and all that, and the kids all liking them. Dell says, Dell sells direct to consumers, and HP is always innovative with their thought leadership out in the market. And Panasonic knew there's no way that they could compete out there in the marketplace. However, they realized with construction contractors and the blue collar trades, they could make the toughest notebook out there. And so they created the tough book. So very niche offering, but they control it and own it 100%. And they show those commercials with this like just rugged laptop that they could throw down in the ground and it wouldn't break. And they were able to tackle that market and own it. And what's interesting is very differentiating. Nobody else does anything like that. And do the customers care? 100%, because all of their teams were breaking their iPads and breaking their laptops out in the field. And so they were able to tackle the market that way, and they own it 100% worldwide. All right, customer satisfaction. Customer satisfaction obviously is critical. You need to have satisfied customers. You can't have a bunch of like bad reviews in Glassdoor. You can't have customers that just don't like you and don't want to buy from you again, and definitely don't want to refer you, right? So this is something that's critical. But here's the thing. Most of the satisfaction scores and surveys that you send out do not give you information that says you have high potential for growth. And this is what Fred Reichheld figured out. And he was a Bain consultant. And he started to understand that as he was evaluating customers and satisfaction, how it affected revenues, that the one question that seemed to always translate to high growth potential for businesses was two things. One, how likely are you on a scale of 0 to 10 to repurchase from me? And how likely are you to refer my business to your friends and colleagues? And businesses that scored well on that were very valuable businesses in the marketplace. And so he created what's called the Net Promoter Score, which is an index now that, I mean, every Fortune 500 company manages their business this way and identifies and gets their Net Promoter Score. So what is it? People that give you a 9 or 10, they're considered your promoters. So you send out your survey and 25% of them give you a 9 or 10. The people that give you an 8 or 9 or 7 or 8, they're just passives. They're probably not going to repurchase from you, and they're definitely not going to refer you, more than likely to your friends. And your detractors are your 6 to 0. There's something they don't like about your business, and they're very vocal about it. So the way you get the Net Promoter Score is you take 25, the 25% here, 25 minus the 5 from your detractors, and that gets you your Net Promoter Score, a 20%. So how does that translate to value? Well, the top companies out there in the marketplace are getting Net Promoter Scores of 55 and up. So if you look at your Apples and Amazons and your Samsungs, your Eventbrites, your Harley Davidsons, they have super high Net Promoter Scores and obviously are incredibly valuable. The interesting thing is the industry average is only a 15. And so I'll give you an example. We had a microbrewery up in Michigan that we were selling, and we did all the value builder work for them and really growing and building their value. When we got their Net Promoter Score, they got a 97.1. I told them, we'll never see it again. And that value builder, or the Net Promoter Score, was incredibly valuable because they had beers that had like a 99.7% satisfaction rating. And it was, while they sold into the Michigan market, they had beers that could go national day one. And they ended up selling for like a 8x multiple. And the Net Promoter Score was a big thing that was marketed as to this huge differentiator. They had massive raving fans that bought their beer all over the country and had it shipped to them because they liked it so much. So this Net Promoter Score is something in the marketplace that There are buyers that hunt for companies that have high net promoter scores because they're 400% more likely to grow faster than their average counterparts. The return on investment for these companies and the growth is just significant for ones that have high net promoter scores. Now, Jason, this one's going to be the great topic because hub and spoke. So this is all going to be talking about owner dependencies. So businesses that are synonymous with their owner or dependent on their owner oftentimes are essentially worthless. Or if they get bought at a significant discount and require the owner to be in the business working for another 3 to 5 years potentially because the business is completely synonymous with the owner. And this whole hub and spoke concept kicked in the airline industry where you had the main hub, so the headquarters, then you had all these airports around them, and they were these spokes. When you look at it from an owner perspective, if you're the hub and all the customers are wanting to chat with you, you're dealing with the suppliers, the design of all the products and services that you sell because you know it so well, the employees are bugging you, it all breaks down. The business is dependent on you, it operates because of you, and in effect, you can only make it so big because you're only one person. And most owner-dependent businesses, the owners are working a ton, they're constantly wearing multiple hats, and it's getting yourself out from under this dependency by building policies and procedures and instruction manuals, delegating authorities and approvals down to your employees, creating sales teams so that your customers go to them first as the first line of defense. It doesn't mean that you're completely out of the business, right? But what it does mean is that the business can operate without you. And for some of you, that may be a tough concept to think about, but this is really critical. The business needs to be able to operate without you there because it's creating a lot of value for your company. You see, strategic buyers are wanting what's called turnkey businesses. They're basically wanting you to sell the company, you take the keys and you hand it to them and you walk away in the sunset and retire. Those are very valuable businesses. This is your serial entrepreneurs that have created and built multiple companies in multiple industries without backgrounds in that because they're great at assembling teams of people that execute their vision for them. And then they go and sell it downstream for a lot of money. This is what we're talking about here. And so we're not saying that it's essentially 100% worthless, but a lot of them are just not remotely worth what the owner is thinking because it is synonymous with them. I mean, Jason, you see this, time and again, probably not being able to represent companies that have owner dependency issues.
Yeah, we certainly do. And we, look at that as part of our evaluation of those companies before we take them to market, or during the valuation process, especially, is if they're highly dependent on the owner, it gets to the point, is that a transferable entity? Is that business transferable or not? So that is part of the selling process and due diligence process when buyers are looking at your company.
No, absolutely. Absolutely. And so this one will be a really critical one for you guys to evaluate and free up your time. And it does come back to freedom, right? It comes back to allowing you to work on your business, not in your business, and to get your time back. What you're also going to be getting is an improvement and increase in your value so that ultimately you can scale the business because you're going to have employees who can help you scale, right? You're going to be able to create a very valuable, sellable business, which is super important. I always explain it this way. I would rather have a valuable business versus a big business. I don't care. I can't tell you how many times in the same industry we see a business that has double the revenue of its counterpart, but the counterpart is worth twice what the bigger company is because they have worked on these value drivers here that buyers are hunting for when they want to find a business to buy and grow and scale. Okay. You'll be able to pass down the business to the kids because you've built all the instruction manuals and you've built a team to be able to execute and grow and expand without you. They can take the reins and take it to the next level. Or ultimately, you can step up and you're the chairman of the company. And you may visit, once a month and have a board meeting with them and your board of directors around you and just help guide the business that way. and you hire a CEO and a management team, and you take the company to the next level. All of these things that we're talking about create value. They make you very sellable to the marketplace. They make you attractive to multiple buyers, which gives multiple options potentially if you are going to want to sell your business to decide how you want to sell the company. And the other great thing is it creates a business that's built to sell. So you may not want to sell the company, right? But it's built to be able to be sold. It's built to go to the next level. And so if you do get a call, like I did with my first company, just out of the blue, and somebody wants to buy you, you're ready to sell. You're not kind of caught with a situation where the company's not remotely ready to go to market, but you may have had a situation, let's say, where your parents got sick and you have to move and you have to sell right then, and you're going to make 50 cents on the dollar. I mean, all these are really sad and real situations that come up. What we would like to do, guys, is, these questions right here are really important for you to understand as a business owner, regardless of whether or not you do want to sell your company downstream. And so what Jason and I would like to do, because this is it time to grow your business, is really important to understand and think about growing the value of your business. What we'd like to do for the attendees, we'd like to offer a free 1 hour consultation with us to sit down. We'll have you take the assessment, which gives you your basically value driver results, and then talk to you about what you do great and opportunities for improvement to not only increase the value of your company, but get your business more built to sell and to give you more options for your company. And so the way that's going to work, you'll get your value builder score through this link here. And we're going to give you the deck, so you'll be able to remember that unless you just want to write that down. You'll complete step 1. It takes 15 minutes to fill out the assessment. And then we'll schedule that 1 hour consultation with you and go over that results. And really we'll be helping you with that decision whether or not to go or grow. And Jason, I mean, obviously it just depends on each situation with the companies, but sometimes they want to grow more, and that's perfectly fine for us. Sometimes they want to sell, but maybe they're not ready to sell. And sometimes I don't want to sell now, but oh my gosh, man, this company is really sellable. And it may make sense to actually go ahead and go down that path.
Well, it's knowledge is power, and we want to give you that knowledge so you can make the best decision to which way you want to go.
No, absolutely. So we'd love to just answer some of your questions right now. And I know, Jason, you've been monitoring that.
Yeah, I see. It looks like we do have a couple questions here. If you'd like, I can read those questions, and either you or myself can go ahead and tackle them.
Yeah, that'd be great.
Someone asked, how will the sale of my business be structured? So typically, Steve, do you want to go ahead and talk about how typically buyers would structure it, either as a purchase of the assets or a purchase of the company?
I mean, honestly, you run across that all the time from the selling perspective, taking companies to market. Asset sale, they're going to buy the assets of the business. So not the liabilities, but the assets themselves. And in the simplest terms, the way they'll value the company will be, I'm going to make it very simple. They'll take your annualized net profits and they'll multiply it by a multiplier. So if you had $1 million in net profits, they'd multiply it by, let's say, a multiple of 5, and you'd be worth $5 million as an example. When you get into the stock sales, it gets more complex. We don't run across that too often on our end, Jason, but they're actually selling and buying the stock of the company. And it falls under different regulations because stock sales are governed by the SEC. And how they operate. And so those types of sales are different, and also deals with ownership and how that works on the stock sales. You're more familiar with that, Jason, than I am.
Yeah, I would say the majority of transactions that we see are going to be asset sales, just for the reasons that Steve mentioned. It cuts off any of the potential liabilities from the past company. And then also it gives the buyer more tax write-offs or benefits for, redepreciation of assets. So they like to do majority of the the sales as asset purchases, but we do see some stock sales as well, where the buyer is just buying the company itself, the corporation. And there's some reasons why they may do that, because there's contracts already in place that are with the old corporation, and to renegotiate those contracts, or to have to do something with those might be very time consuming and difficult. So the majority of them are, it just really depends but the majority is going to be an asset purchase.
Yeah, usually from the buyer perspective, they'll decide. You may get multiple buyers looking to buy your business. Some of them may look at it as a stock sale. Others may look at it as an asset sale. Some may say, hey, I'd like to buy your business. We'll put 50% cash up front. We'd like the other 50% is what's called an earnout. So that, let's say you're going to work in the business for the next 2 years to earn the next 50% based on targets that are achieved. And if you do better than that, you could actually make more money. You may see buyers that come in and say, we're going to buy your business through like an SBA loan. So I'll put 10% down with the bank. The rest of the money we'll get as a bank loan, and we'll pay cash for your business that way. There's options where a buyer may say, hey, are you willing to do like seller financing? So you would create a note and you would get a nice interest rate on it, let's say like 10%, and they would pay you over time. So you would get that interest based on the agreed to sale amount. So the reality is that the reason why you want to get your company built to sell is so that you do have a lot of these different options. We even see situations where I'll sell 80% of my company. I'm going to retain 20% in the new company with the new owner. We're going to then grow the business over the next 5 years and resell it. And that 20% may be worth more than the 80% that you sold your business for. So there's many different ways to sell your business. The key is you want options. And so companies, like we mentioned earlier, that are built to sell, like we talked about, that are strong in the results of the assessment. Let's say they've got an 85 or a 90 score. They're going to sell for a lot more money than the average business. And there's also going to be a lot of options for the owner to decide how they would want to sell their company, because they may pick an option that, even as a person who's selling the company, may not think it's the best one. It is for them because they have 10 options to decide what to do with, versus a situation where you only have one buyer. You're not necessarily positioned in the best light, and that's what you're going to get. And so if it's ultimately what they're going to pay for your business. And sometimes you get in tough situations where they're just not going to get as much because they're just not set up in a way that's going to attract buyers.
Hey, Steve, I've got another question from Mark. Mark has recently become a client of IAG, and he wanted to know if we would recommend him having the consultation with us for an hour, if that would be beneficial.
I mean, I really think it would, because the selling process takes time, right? And so one of the things that we'd be able to do is look at and showcase what you do well, right? So something that you really want to highlight and articulate to potential buyers who are out there. But we also may have some time where on things that you have an opportunity to work on, we can talk through that to really, during this time frame when you're selling, to increase the value of your company. So absolutely, I would highly recommend you to take that based on this link here, and then let's just sit down and talk with you. Regardless, it'll be a great conversation. There's a 27-page report that we'll give you after that talks about your strengths and weaknesses and the different drivers based on your score. That's also a really good takeaway as well.
Yeah, I think it's great for anybody thinking about going into the market right now to have that information and lean on Steve and I's experience of going through this process many times.
Yeah, absolutely. I think it makes, tremendous sense to do that. I would recommend any business, whether you're going to sell or not, to really go through this. You're going to get information that as a business owner, you may have not looked at or thought about before when you put that buyer's lens on, and how a buyer who's more sophisticated, a lot of capitals, maybe grown a lot of companies, or they've been a very senior executive in the marketplace, or they're a family office that buys companies. they're going to have that level of sophistication. And these are things that they're hunting for because there's millions of businesses out there. So they're hunting for these needles in the haystack. And so if you can go through a process like this and get your company more valuable to the market, you're going to do really well when you sell. Absolutely. Well, one thing I wanted to show you guys is this appendix here. When you get this, you got different exercises that you guys can go through and just be thinking through to kind of help yourself with some of this, right? For some of the key value drivers that are out there. So that's a nice little takeaway for you all to have this exercise for you and to really just help working on building a valuable company. That's what this is all about. You know, if you want to achieve the American dream on the back end, especially if you don't have, you know, a big retirement set up and this is your nest egg, by golly, you know, you don't want to just go give it the college try and end up not making that much when you have, you know, 20 years, 30 years left of your life. You really want to create a business that is built to sell and that will attract those buyers so you can get the maximum price at exit and you can go travel the world. You can work on charities. You can start another company or do something else. There's a myriad of options that you'll have after. So we just want to thank you for your time. We really appreciate it. Thanks for sitting down with us. We look forward to visiting with you guys next. And like we said, we'll get this deck out to everybody and would love to have you guys take the assessment and sit down and visit with you. Thanks, everybody.
Thanks, everybody, for joining. Have a great rest of your day.
Yep. Bye-bye.
Bye.